So I like to tell investors when investing in commercial real estate, specifically multifamily apartments, and the deals that we do, your money is tied up for a period of 3 to 5 years-ish. And there's some parameters around that, and I want to go into more detail. One question I get asked is that 3 to 5 years, like, do you wait until the end of 3 to 5 years to pay us? And the answer is no. We want to pay our investors back as fast as possible. And the reason why that is because when we're doing our calculations for returns, it's based on a function of time. So time, frequency of distributions, and the size of those distributions. So if we're able to return a bunch of your money back to you as fast as possible earlier on in the project, that helps make our returns look better, and it helps to boost our track record. So let me go into the deals over this 3 to 5 years. So first, when we buy these properties, we are doing value add. So it's worth one price, one value, and we force the appreciation by doing renovations, interior renovations, exterior renovations, and forcing that appreciation. We borrow money from the bank to do those renovations. And the money that we borrow is kind of expensive capital. The interest rates are higher on that. So we want to get out of that loan as fast as possible. It's called a bridge loan. And usually, depending on the size of the project, it could take us a year to finish all of our work. It could take us 2 years, it could take us 3 years. For example, if we buy a 400-unit apartment complex and it's 100% occupied when we close, we're not going to be able to get into those units, those apartments, to do renovations for a while, right? Versus that 400 at 80% occupancy at closing, we're able to get into 80 units day one to start doing renovations. So we can finish a lot sooner. So we can do that refinance out of the expensive bridge loan into a less expensive, longer term agency, Fannie Mae or Freddie Mac loan. It's called a bridge loan because it's a bridge to agency. That's why it's called a bridge loan. And so our goal is to get your money back in your pocket. Now here's what happens. So we get out of our bridge loan, we refinance. Hopefully by this time we've created enough value. Hopefully by this time it's a good time to do a refinance, because right now, like as of this recording in August of 23, sort of a funky time to do refinancing, but we are in one of our deals just because of where interest rates are, right? So if it's the right time, we'll execute a refinance. Hopefully we've created enough value to be able to take on a new loan, and more importantly, pull out enough cash out refi from the new value we created and return anywhere from 10 to 40% of our investor capital back in your pocket as a result of that. It all is dependent upon the deal and a bunch of parameters, but that's the goal. So with that money back in your pocket, right, you're able to invest in another deal, another project with us, or you could go take the missus or the mister to a vacation somewhere if you want, right? Or you keep putting it to work for you. I prefer the keep putting it to work for you strategy, by the way. But that's sort of really it. Then your money is, the remaining money is still in the deal, right? You're earning ideally cash flow at that point in time. And then somewhere around year 5, could be sooner, could be a little longer, right? Depending on market conditions, we'll exit the property, we'll sell the property. And that's where the remainder of your returns are, returned to you. And that's where your profit really is kind of kicks in. Now it does happen where, depending on if we buy right, somewhere in that year 2 to 3 timeline, we're able to do a cash out refi. Maybe you get all your money back, right? And then your money's still in the deal. At that point in time, maybe we consider holding out a lot longer because all your cash is out, right? Does it matter anymore? Let's just keep riding it out and cash flowing, and then maybe wait until year 6 or 7 to sell, right? So it really is very dependent on the deal, the situation, the circumstance. But at least explaining generally how this works and our motive behind this idea that your money is illiquid. It's tied up for 3 to 5 years. What does that mean? And do I get it back, or do you wait until year 5? No, we want to get it back to you as soon as possible. Hopefully that was useful for you, and I'll see you next time.